I have to ask you the $1 million question $1 billion question that everyone wants to know after you said that. How much more of a run window or run rate do we have for these 7 companies to pour all of this money into this tech before we'll see a slowing down?
It's
Since you scared the hell out of everybody tonight.
Well, it's tricky because Microsoft was the first with an enterprise scale product, Copilot, which effectively it's a ride along AI service that is supposed to make your software coders more efficient and give them more assistance as they work so that they can churn out, they can be more productive and they can churn out more work product and do it more and do it quickly. It's a great product. It's not the best product on earth, and of course it'll get better, but they didn't really have much to say in terms of like how well they're monetizing that. It doesn't mean that they're going to give up or they're going to slow their spending, but like we don't want to hear anecdotes like that start to really pile up. Another great example will be what we hear from Apple about Apple Intelligence, which is their native AI. It's built on the chassis of ChatGPT, but basically everyone that upgraded their phone to the iPhone 16 now has the use of Apple Intelligence if they want to use it. We don't really know to what extent that's being used, and we don't know how profitable that activity is for Apple. So, like, we're going to learn a lot now that there are enterprise class products in the marketplace, and it's not just people experimenting, it's large corporations that have made an investment. We're going to start to hear what that investment is doing, and that could be really bullish. That doesn't have to be a negative catalyst. One last thing I want to put on your radar, guys. It's not clear that NVIDIA is going to be able to maintain its level of dominance thus far by the end of this year. All of their competitors are building their own chips now. Yeah. Amazon is building its own chips. Alphabet, Microsoft, Apple, they've been, but now they're building AI chips, and they can't exactly build Blackwell GPUs the way that NVIDIA can, but they don't necessarily need a Blackwell GPU, which is, very powerful, highly flexible. What we're starting to see now is some of these companies are building what we call ASICs, or application-specific integrated circuits. Mm-hmm. ASICs are nowhere near as powerful as GPUs, but they get the job done for certain narrower tasks. If there's a shortage of GPUs, which NVIDIA says they're sold out 12 months in advance, it's not like you're going to see these companies sit there and wait. They're either going to turn to the AMDs of the world and be more open-minded about using a competing product, or they're going to develop their own silicon in-house, have it made by Taiwan Semi, and just plug that in while they wait for more compute power to come along from NVIDIA. So there are some interesting cross currents happening within tech where some of these companies that are the biggest customers of NVIDIA are also starting to sort of look like they also want to compete.
So historically, the S&P last year did 25%. In 2023, it did 26%. So back-to-back 25% years. Now, you know how many times in history the S&P has done over 20% 3 years in a row?
Very rare. The late 90s, which is my start in the business. I can't think of another example.
Exactly. One time. 95, 96, 97. One time in history that it's ever done that. And then presidential cycles, the first year of a presidential cycle usually is a weak market. The second year is a bad market. Third year is a great market. And the fourth year is a good market. Okay. So those two things that I just named are not good for the market in 2025, but we also have a historical presidential cycle, a historical presidential candidate that's been elected. It's a lot of things that traditionally might not have happened that can happen this year. But history would point that this would be a down year in the market, or at least a down year compared to the last 2 years. What are your thoughts on that?
So I think it's too complex to take, 3 or 4 historical examples that we have. Because guys, keep in mind, like, we're not playing with 1,000 years worth of data. we're playing with we use CRISP database, so we have like 100 years. We have 99 years worth of stock market data that we would consider to be reliable. When you see people do studies on stock market performance, most of those studies start in 1926 because that's like where the reliable data that we have on stocks really starts. You'll see a lot of studies begin in 1950, which is the earliest that we can really take like S&P 500 data. So I would say we don't have a big enough sample set to know that the presidential cycle or the amount of years with back-to-back double-digit returns are enough to make a definitive statement. But I don't ignore it, and I'm with you guys. It's definitely something to be aware of. There's a couple of distinctions here, though. The first is the Fed is easing. We're in the first bull market that's ever started while the Fed was raising rates. I don't know if you know that. So like it's a really unique situation that we're in. And we don't know how many Fed rate cuts there will be this coming year. I think the market is forecasting 2 or 3. Let's assume it's just 2. They're not raising rates. We don't think they're going to have to raise rates. The labor market slack that we now have, the amount of people who are having difficulty finding a job, credit card delinquency rates, all of these things are ticking higher, which I think keeps the Fed from scaring the market about, staying high or raising. So now we know we're getting cuts. We just don't know how many, and we don't know what the timing will be. So that throws a wrinkle in that. The second thing is that earnings are growing. We should see 8% earnings growth this year. It would be pretty rare to find ourselves in a bear market so long as the Fed is cutting and earnings are growing. So I think it's not going to be simple. This particular president wants to make a lot of noise about tariffs. He kind of wants to have a clean slate with all of our trading partners and start over as though there are no precedents and just like see what he can get so that he can tweet about it. Like it's a whole different world. I think the tariff announcements are going to introduce more volatility in the first quarter of this year. So I used the term potential landmine before about NVIDIA's earnings call. Another potential landmine is how vocal Trump wants to be about tariffs. Even if they don't start implementing them in the first couple of months, just talking about it, I think if you look at 2018, could definitely introduce some volatility.
So you think it's gonna be a good year for the market?
I do.
I'm with you. I just like to just have play devil's advocate on this situation.
God's advocate.
I'm with you guys, and for the last 15 years, I've been reading about the recession that's coming. We've been in recession 2 months out of the last 15 years. Yeah. I don't know if most of the viewers even realize that.
But it's also been unprecedented amount of money that's been printed.
100%. But that's not the whole time. I'm saying 15 years. So look, if we say right now, here are the big pieces to the puzzle. S&P earnings growth that we think is coming. We think about 8%. Tech, it'll be a huge contribution to that, but so what? And then we think the Fed is probably cutting twice, maybe even 3 times. By the way, if the economy gets materially worse, that number could be 7 times. You got 10 Fed meetings this year, not 9 Fed meetings this year. So like those things are in our favor. What's working against us is a very volatile administration that likes to throw out a lot of ideas. Some of them they don't even follow through with. So I think like the right way to phrase how I feel about this year is I'm bullish with the expectation of these bouts of volatility. Now, I also reserve the right to change my mind. If these technology companies start warning and lowering guidance, all bets are off. Yeah. We're at 21 times earnings. The only way you stay at 21 times earnings, which is substantially elevated relative to history, is if the news flow stays good. You ain't keeping that multiple if the biggest companies in the index start telling you, okay, things are still good, they're just not great. So there, you could have a situation where earnings grow, but the stock market is flat or down because we get multiple contraction and people are just less willing to pay up for the earnings that actually materialize. So I try to give people both sides. and not just present, here are all the reasons to be invested and not worry. I think you should be invested, but also you could worry a little bit. That's okay too. That's healthy.
Yeah.
Also, really quick, can we tell them that 25% should not be the expectation for any index?
Yeah. If we do 14, I think we're happy.
Yeah,
You know,
7 to 12 is the norm.
If I sat you down at the end of 2021 and I said, I'm going to make a deal with you for the next 3 years, 1 year, the S&P will close down 20%. 1 year up 27, 1 year up 25. I can't tell you the order. Would you sign up for that? You probably would sign up for that. Most people would.
100%.
Well, that's what we just lived through. So, I mean, it's so that's how averages are formed. One of the most interesting things about the research that we do here. So, just to back up, we're doing financial planning work for people, which means we have to bake in expectations for future returns of asset classes in order to give them guidance about where they should invest, what proportion should be in what asset class, what their expectations should be relative to their goals. We have to do all of that work, and it's probabilistic work, but we have to put some sort of an average into the formula to come up with the right portfolio. So you have to give people like, all right, S&P 500, large cap US stock exposure. We could bake in like an 8% return assumption, which is a really healthy return assumption. The thing is, over the last 10 years, it's been more like 15%.
Yeah.
So all of our plans undershot on how much the market would go up, which means people's retirements are even more fully funded than they expected, which means my financial planners have to go back to people and say, great news, you have way more money than we thought you would by this time. You have two choices. You could up your goals and we'll maintain this allocation, or you could take less risk and we don't have a problem here, but we probably shouldn't do nothing, right? Okay.
Yeah.
So thinking about market returns, one of the most interesting things that we come up with when we look at that average 8%, it's that the market almost never does 8% on the nose. That's where you get those average returns from, is negative 20, plus 25, plus 27. That's where you get an 8%. And if only it were something that you could schedule like a train station. You just can't. You don't know which train is coming in and which one's going out, but you have to be able to bet on that longer term assumption. And where does that assumption come from? Earnings growth, margin growth, interest rates, and productivity, the efficiency of companies. You have to make that bet that companies are going to be better versions of themselves 10 years from now, 20 years from now, in order to hit that average annual return of 8%.
Yeah, that's interesting, man. It made me think of the customer that you had, or the client that you had, that wrote you the letter that they had made $1 million in NVIDIA shares, and it was the first. They never thought they could do it.